Hey everybody, we are back still discussing business entity types. The next topic is deduction of business entity losses. And this is really important because think about it. If you run a business and it loses money, you're not happy about that. But if there's an advantage in that you can use that to offset some other income and get a deduction, a tax deduction, that would be great, right? But it's not as easy as it sounds. So let's go and dive into some details on trying to deduct business losses. All right. First thing is that business entity losses have a few limitations. First, if you create in your business an NOL, a net operating loss, you generally can only use that to offset future income. All right. So that's one thing we have to be aware of. And there's some other loss limitation hurdles that you should be aware of that we say you have to clear in order to deduct a loss. The first one is a tax basis hurdle. In other words, if you don't have enough tax basis in the entity, you're not going to be allowed to deduct the loss. Same thing is true for at-risk limitations. We have something known as at-risk basis. And if you don't have enough at-risk basis, you're not going to be able to deduct certain losses. Then we have our PAL, our passive activity losses, or I'll say our PAL. Passive activity losses can only be used to offset passive activity gains. And finally, there's something known as excess business loss limitations, which means that the IRS doesn't want you to deduct $10 million a year every year in business losses. So they put a cap on how much you can deduct. And we'll get into all of these in much more detail as we go through the sessions. Right now, we're just kind of explaining high level certain concepts. Okay. All right. So here's something that they'll try to confuse you on. Something known as a hobby. What exactly is a hobby? Well, it's an activity that you participate in. You might make a little money from your hobby. You might have some expenses in your hobby. But what if that hobby loses money? It's not a business. So can you deduct those losses? Answer is generally no. All right. Hobbies for tax purposes are what we consider not engaged in for-profit activity. And if they're not engaged in for-profit activity, they generally cannot deduct losses. All right. So what we have to be aware of is this deduction of expenses for these hobbies is not going to be allowed. All right. You're not allowed to deduct hobby losses or hobby expenses, only business losses and business expenses. So think about someone in their backyard has a beautiful garden and they spend a lot of money on that garden and they say, you know what, I should be allowed to deduct some of this because I grow stuff and I eat it. So I want to deduct these losses. No, it's just a hobby. It's your backyard. You're not selling it. But compare that to a big garden center, right? Where they have a big inventory. They have a lot of employees working there and they have an entity formed and they keep their books. This is a business. So that is engaged for profit and they can deduct their losses and their expenses. All right. So we have to determine whether or not something is considered an activity engaged in for profit. All right. Is it an actual business? So there's a lot of factors that we should take a look at when we're thinking, is it for profit or is it just a hobby? All right. So some of these factors we have to consider, questions you ask yourself, and no one of these by itself answers the question, is it a business or is it for profit versus is it a hobby? All right. But you have to look at all of them in the aggregate together. And that's the IRS's job, really. So here's what we have to look at. Ask yourself, does this taxpayer carry on business in a business-like manner, right? Do they form a business? Do they complete and their accurate books and records, things like that, right? Also ask yourself, are they experts in the areas of practice or do they have to seek advice from other people? Look at how much personal time they devote to this particular activity outside of business hours, right? More of a hobby than a business. Or what about the assets that they purchase for this activity? Do they expect them to appreciate or depreciate in value? And also, has this taxpayer done this type of activity before and taken something that was unprofitable and turned it into profit? In other words, they'll look at a history check. Have they done it before and turned it into a business? Right? That tells you a lot. A couple of other things to look at. You want to have this history, as I said, and look, have there been sustained losses beyond reasonable startup losses? If that's the case, probably a hobby, okay? And what about an occasional big profit, even though there are some losses? Why is that happening? So you have to look at all of this and see, does it more line itself up with a hobby or with a for-profit activity? You even want to look at, do you earn substantial income or capital from other sources? In other words, do you have another full-time job? If you have another full-time job and you're doing this, it might just be a hobby, right? And also you have to look, Is it something you do personally for recreation that brings you a lot of enjoyment? It might be considered a hobby. Now, you could say, Mike, I could make arguments that, hey, I have a hobby that I love doing, but now I turn it into a business and I make money from it. That's fine. That's fine. There's no right or wrong answer. This is very gray. It's not black or white. It's not right or wrong. And that's something that we have to answer the questions and be able to argue to the IRS if they ever question a client's ability to deduct losses, right? And they say it's just a hobby. And we say, no, it's not. It's a business. So we have to know these questions and know how to answer them, all right? Now, here's another thing that they'll look at, the 3 of 5 year presumption. Now, what is a 3 of 5 year presumption? Well, an activity for profit is presumed to be engaged for profit like a business if it's profitable 3 out of the last 5 years. So that's a great fact right there. If you can say, hey, we've been profitable 3 out of the last 5 years, that's more in line with what a business is. Now, maybe you're not profitable 3 out of 5 years. You could still make the argument and it still might be considered a business, but this would just help you make the argument. But the burden of proof, after you go through this 3 out of 5 year rule, the burden of proof is on the IRS, okay? It's up to them to prove, no, this is not a business. It is more an activity, more just a hobby. And that's good. That's good for the taxpayer because why should you have to prove it is a business? Let the IRS disprove that it's a business and just a hobby. All right. Now, if it's not a business for profit, if it is a hobby, in other words, if you're not engaged in a business for profit, you are engaged in a hobby, what does that mean? Well, if you're not engaged in for-profit activity, guess what? You cannot deduct your expenses. You cannot deduct your losses. But, however, you need to know this. If that hobby generates revenue, guess what? You have to include it in your gross income. So the IRS says, listen, no matter what hobby for profit, if you make money, there's income, you tell us because you're paying tax on it. If you're a business for profit, we'll let you deduct expenses and losses. But if you're just a hobby, you have to pay tax on the income, but you get no deductions. So that's why people really want to make sure the hobbies are considered businesses and not hobbies because they want to be able to deduct the expenses. All right, let's take a look at this illustration. We have someone here named Anna. Anna has a full-time job as a corporate financial analyst. Nice job Anna has. Now, she loves to bake cookies. Oh, who doesn't love cookies, right? And she has a signature chocolate chip cookie she makes, and her friends love it. Her family loves it. She shares it with her work colleagues. Everybody loves it. Occasionally, she even has people that pay her for her cookie platters for their big fancy parties and things like that. So she actually incurred in the last year expenses related to all the baking and ingredients and supplies, total $5,000. So a substantial amount of expenses she has. But guess what? You know, she had some income. The income, just $800 from 3 different events she charged money. So she had income of $800. She had expenses of $5,000, so she really lost $4,200 on this, and she wants to deduct it. Can she? Well, let's think about it. Let's think about Anna and what she does, and what does she do? The cookies. Do you smell them? If you look really closely at the screen, you could almost see those cookies, right? Who doesn't love cookies? Oh, oh, goodness. I love chocolate chip cookies especially. I wish I knew Anna. This cookie is so good. All right, so we have to answer this question about Anna. Hold on. I need a sip of milk. Cookies and milk, my favorite. Okay, back to Anna. What's going on here? Well, we have to know, is she a for-profit business or is just as a hobby? What do you think? Well, if we look at all the facts, she has this baking cooking activity, but it's just going to be a hobby. Why? Because she doesn't have a business set up. She's not keeping a lot of books that they tell us here. They don't give us enough information for us to know this is an actual business. You know, you want to form an entity. You want to make sure that you check all the proper boxes. Otherwise, it's going to be considered a hobby. And what does that mean? She has to include that $800 in her income, but she will not be allowed to deduct any of the expenses of the hobby. And that's no fun. No fun for everybody. And she makes such good cookies and she doesn't even get the tax break. Can you imagine that? Boy. All right, let's go. Now, let's advise our taxpayer clients on certain things. So they're talking about running a business And now we're back to business. Forget hobbies now. Let's get back to running businesses, all right? And that business loses money. Let's say you have a flow through, right? You could flow through losses directly to the owner. And what's so good about that in the flow throughs? You can offset income from other sources. So that's a big advantage of your flow through entities, right? If you're a C corporation, you don't get to do that, right? Because the losses at this point are going to stay with the C corporation. Now, we'll do an example where you see how this works in just a moment, all right? So the particular advantage for this new business where you have these startup losses, that's not uncommon. So you start a new business, you put a lot of money into it, you don't make a lot of money, you have big losses up front. You want to be able to deduct those losses up front. Well, as long as you have sufficient basis. Remember I told you about those hurdles, tax basis hurdle, at-risk hurdle, things like that. If you have enough basis, guess what? And you actively participate in the operations, you get an immediate tax benefit of deducting the losses to offset other income items that you have. That's an advantage of a flow through over a C corporation. Now, if you're a partnership, you could actually flow through more losses, deduct more losses than an S corporation. And the reason why, when we calculate basis, it's done a little differently between a partnership and an S corporation. It's something we'll talk about a little bit later on. But in a partnership, when we calculate basis, it includes not only all the money you invest, but also your share of debt. All right, your share of partnership debt. But in S corporations, your basis in the stock does not include the debt. So that's why your basis is greater. And if you have a greater basis, you could offset bigger losses. All right. Okay, here is our example. Let's talk about Don and Mary. They're forming a new business together and they're going to be equal owners and they have substantial basis. They put a lot of money into this business. Now they both actively participate in the business and they expect this business is going to generate losses for the first few years, which is not uncommon. So they don't plan on taking any distributions because the business is going to lose money. They're not going to take any other compensation either. So here's what they want us to answer. They want us to identify the entity type that would be most advantageous from a tax perspective. Well, think about this. If you're a C corporation and there's a loss, it creates an NOL, a net operating loss. And you have to carry that NOL forward to future years when you're profitable and you have income to offset. So we're not going to get that for a while. We have to wait for this business to generate profits. So we're going to have to carry that NOL forward for a number of years before we can deduct it. And even when we do get to deduct it, we can only deduct up to 80% of future income. So the problem with the C corporation here, there's going to be a delay in recognizing these losses. So in this particular situation, a C corp is not a good choice because being able to deduct the loss will be delayed. But compare this to an S corporation or a partnership. Here, the losses can be passed to the owners immediately and offset other sources of income. And that is a good thing. All right. We know that the owners, Don and Mary, have a substantial basis, so we don't have to worry about clearing hurdles. We'll be able to do that. And we know they're active in the business. They told us that as well, which is important. We can only do this if we're active, right? So the S corp or the partnership is going to be a better choice. Why? The loss deduction can occur immediately. Okay. All right. I hope that makes sense to you. That's everything we want to cover here. So I have some really important stuff that I need to get back to. So look over this stuff, try it out. If you have any questions, shoot our tech support, our support staff emails with your questions. I'll be there looking for them, eating my milk and cookies. See you in a bit.